In other stories now, we see Africa's richest man, Aliko Dangote, has unveiled plans to build another 650,000 barrels per day refinery in East Africa, signaling an ambitious expansion of his refining footprint beyond Nigeria as the continent seeks to cut reliance on imported fuel. Mr. Dangote disclosed this during a presidential panel at the Africa We Build Summit organized by Africa Finance Corporation in Nairobi, saying his company is ready to replicate the scale and model of its Lagos-based refinery if governments in the region provide the needed support. We'll definitely be tracking that, but let's discuss the oil market price performance this week and other matters now. Joining me for this is Chinnan Dikwal, Vice Chair, Africa Energy Council, joins me via Zoom. Great to have you on the show. Well, good morning, Chinnan from Doha. So I think you have to unmute, though. I saw your mouth moving, but I couldn't hear you. But we're seeing oil prices, they're up, despite the ceasefire extension. What is the market really reacting to? Is it peace signals or lingering geopolitical risk?
Can you hear me?
Okay, I could hear you. I could hear you for a moment there, but I guess we'll try and get you back on. But we'll try it again, Chinnan. But
okay.
Oh, fantastic! I can hear you now. I can hear you now.
Oh, sorry, I apologize. Yeah, sorry for that thing system. Yeah, Ladi. So it's I'm going to say to your point there that we have seen a bit of a yo-yo in the oil market the last few weeks, and unfortunately that has not changed at all. One moment we're risk on, the next moment we're risk off, and it's risk on and risk off, and that's been the situation for the last couple of weeks. I think what we're seeing between yesterday and today is that oil prices have gone up again, $106 per barrel right now as we speak. Last week it was actually down to approximately $98 per barrel. So it's it's going up and down. But I think the bulk of it really are the people are the markets are responding to the spot events that are happening on the ground in the Strait of Hormuz. We're seeing that the US maintains its blockade of all Iranian assets going in, and that's causing a lot of traders to be rattled. The Iranians, of course, still holding the strait in chokehold. So that sort of quagmire is what we can see in the oil markets. But I think the welcome development here is that the ceasefire has been taken off indefinitely for now. We don't fully understand what that means exactly, but I think that's a good sign for dissipation of the conflict, a tiny bit.
Oil price performance, that's for both benchmarks for this week. That's week to date. We still have the trade today, and things could change. We're seeing Brent futures, that's up about 18.63% week to date. WTI oil futures up 16.66% week to date. So whatever happens today, I don't think it's enough to drag the prices down to get a weekly loss, just like last week. So do you think markets believe the ceasefire is temporary? And how much uncertainty is being priced into Brent and WTI right now?
Yeah, a huge amount of uncertainty. 18% up on Brent. That's a very significant number. And we're talking about the futures price. So people are betting that a month from now, a month and a half from now, the situation would even contract more. So, if you think about it, right, the ceasefire has been taken off, but the US strategy there is that of a chokehold. They're holding off any Iranian assets to use that as a pressure point to get them back to negotiate. And we have seen what the Iranians have been doing the last couple of months. They're very resilient and quite headstrong, and they're not getting back at all. So the question there, and I think this is the fundamental thing that many traders are baking in: how long would it take for all of the Iranian production to keep running? So if you think about all the oil that's being produced and going into storage, how long would it take before all of that oil fills up storage, and therefore there's no evacuation into international markets, if you see what I mean, and ultimately brings them back to negotiate? So I think that's sort of the calculation that many traders are having there. Would that be enough to get them to negotiate? Nobody's entirely sure. What mode of response would they have to that sort of chokehold is not entirely clear, and you can see that very clearly in the price of Brent and WTI.
Right. Even though we see uncertainty, so far this week. Do you expect some kind of surprise today?
You know, Laddie, it's a difficult thing to answer because we get surprised, you know, virtually every time. So right now we're talking about oil about $106 a barrel. It's very possible in the next couple of hours we could see a tweet or, you know, a truth, if you like, by President Donald Trump, you know, about the converse to this situation, and you'd see the price coming down. We have seen this too many times. In fact, in one day last week, we saw price go up and come down in a matter of 24 hours, you know, in a very short space of time. So do we expect to see a surprise? Honestly, short term, possibly, but I think I align with the market sentiment. I think for the next month, it would be risk on, without a doubt, because you can see the strategy being deployed is that of, you know, holding a bit of a chokehold to get them back to negotiate. And these guys are being really headstrong. We haven't seen that. So I am not super confident. I think the situation will prolong for the next couple of weeks, maybe months at a minimum. And then perhaps at that point, you know, we could have something to happen. But certainly in the short term, anything can happen. I think short-term volatility. So, Laddie, I think the fundamental thing actually that many traders talk about is volatility is permanent. Volatility is the new normal. In the past, if we had, you've just shown me today, 18% on the price of on the futures price. If we had 5% up on futures price in the past, it was something that was completely out of the ordinary. Today, volatility is permanent, is here to stay. So any countries, any companies, any traders have to bake that into the analysis. You have to find a way of baking that as a permanent structural change. This is not just noise. This is signal now. Volatility is signal. It's not noise anymore.
All right, so it was quite interesting, you know, watching 2025, you know, with gold prices, you know, hitting new highs. Then we come into 2026, and oil is getting all of the attention. I'm wondering what's going to happen in 2027, you know, at this point. But with oil prices surging on, you know, geopolitical tensions, what are the, you know, broader implications for inflation? We're already watching March inflation numbers, you know, so far. Do you think going forward we should expect shocks with inflation?
Without a doubt. So I'll say this, right? So, like, and if you ask me, for me, very fundamentally, the oil price and oil markets had a huge chunk of attention this year. But the real story that many people are missing is around gas. I think gas and agriculture. When you look at the Strait of Hormuz, there's been a chokehold. A lot of the focus has been on oil. Okay, its price has spiked. But gas and LNG is the biggest story that nobody is talking about right now, and the shortages. Even beyond that, I would say fertilizer, agriculture, is the biggest shock that we haven't yet experienced. So to your point, fertilizer, you're not going to see it in 26 because of all of the stockpiles and all of that. The real problem with fertilizer due to this disruption is going to happen in 2027 when the farming season comes and you realize that there's a big gap and a massive shortfall in terms of fertilizer supplies and all of that. So yes, you're 100% right. The short-term things that hit people right in the pocket, refined products, crude oil and all of that, we've seen and we've dwelt on it so much. Gas, I think there's been a little bit of focus on it, particularly in Europe, but not so much around the world. Fertilizer is the biggest blind spot. And in Africa, we are in real problems, I'd say, with regards to that. So do not forget, just in the Strait of Hormuz alone, most of those Gulf countries account for approximately 25 to 30% of global fertilizer production. Okay, so if you can think about that all of that supply has been constrained for the last, almost 2 months, certainly more than a month, then you can see that we are in for, quite a challenging farming season. I think this is the key thing for many people to bear in mind. But certainly from an inflation standpoint, I would expect to see that next year, yes, inflation doesn't go away. So don't forget, Ladi, you and I have had this conversation. Before the war, inflation started to taper down. Inflation was tapering now. We saw the Federal Reserve come in, they cut rates a couple of times, making lots of adjustments into the economy and all of that stuff. All of that has gone off the window. With the tariffs that we've seen and disruption that tariffs have brought, and right now the disruption of the Iran war that we've just seen, I think, and we started to see it actually, inflation started to go back up, whether you're talking energy inflation, so, headline inflation, as it were, everything around it, core inflation, but headline inflation as well. I think that for the year 2027, a lot of central banks will be really fighting to keep prices, to taper inflation, for sure.
because coming into 2026, in 2025, we're seeing the central bankers are getting quite comfortable. You know, they're cutting of rates, but now they have to rethink that. I guess it's holds we're going to see for now. But let's flip over to investments now. Refinery investment. You see, Mr. Dangote wants to replicate the 650,000 barrel per day refinery in East Africa. How commercially viable is this? You know, given the challenges already seen in Nigeria.
Yeah, this is without a doubt, I think one of the, if you ask me, one of the genius moves that Dangote is here. No question about that. So I'll give context to that. Firstly, he made those statements, like you say, at the Africa We Build Summit in Nairobi. It was a conference that was put together by the Africa Finance Corporation. Who was in attendance? One of the big wigs across Africa, the who is who of energy and capital and finance across Africa. So, and presidents as well. We had Yoweri Museveni of Uganda. We had President William Ruto, and several presidents all there in attendance. So it's a big conference. It's a big deal without a doubt. Of course, Dangote was there, and several other financiers and industrialists. Now, the key thing there is Dangote is making a huge pitch and a bet to the East African side of things, okay, the East African continent there, saying, listen, if we look across Africa, the East Africa is one of the places with the lowest refinery capability. I can come in here and set something up to enable you become energy secure. So for context, we were saying all of that at the back of a report that was just released by AFC, which was termed the State of Africa Infrastructure Report. In that report, it made it very clear, it made it super clear that Africa imports approximately 70% of its refined products. So think about that. Huge endowments of oil and gas, but importing 70% of its refined products, petrol, diesel, kerosene, all of that, jet fuel, 70%. And if you look across West Africa, with Dangote coming in, much of the gaps in there, a lot of the gaps have been filled, not all of it, but certainly a lot of the gaps there have been filled. You go to North Africa, very secure, energy secure with Morocco and Algeria and Egypt, lots of refineries, very energy secure. You go to the south of Africa, deeply energy secure with the refineries in South Africa, Samref, all of those refineries there. East Africa has a huge gap. So when you look at that, and Dangote is making that pitch to say, listen, I can come and set it up. Uganda, Kenya, Tanzania, South Sudan, and all of those countries that he is making the pitch that he can come and set up and create a huge amount of jobs, put value into the economy, and turn them energy secure. The pitch, Ladi, links back to what you and I have just been talking about. The Middle East is shut right now. The whole Strait of Hormuz, all of the refined, the refined products that are meant to hit Africa are not there. There's huge amount of desperation. It's a genius move. But to make that happen, Dangote would need policy alignment. It's not just to say, I'm going to just extrapolate what I've done in Lagos. It doesn't work. You can't extrapolate what you have in Nigeria into East Africa. There's a lot of uniqueness there. But the point he's making, which I agree with, is he needs policy alignment between the various countries. So Yoweri Museveni of Uganda, William Ruto, and all the other guys have to come together and give favorable terms and policy incentives for this to happen. But I think it's a clever move as well. He's proposing a 650 barrel per day capacity, very similar to Lagos. So ultimately, there's no need for redesign. A lot of risks in that project are known, and a lot of them sort of mitigated in lots of ways. It becomes just a thing of picking up from Lagos, technically, okay, plugging it, yes, in East Africa, but then putting all the uniqueness of East Africa around it. So it's a fantastic, a play by Dangote, for sure.
Right. How do you think, let's just imagine, he gets the refinery running in East Africa. How do you think he's going to handle pricing the products there, like fuel? Right now, Kenya pays the highest for fuel there, $1.60. Uganda, $1.46. The cheapest, I think, is Ethiopia with about 91 cents, according to recent data. And we're already, seeing youths already protesting in countries like Kenya about, rising cost of living due to rising energy prices. How do you think he'll handle pricing in East Africa.
But Larry, isn't that exactly the need for the refinery? To your point, $1.60 per liter, huge price, right? So if he comes very cleverly and pitches and shows that, listen, a refinery at your doorstep means that the refinery is right here. Transportation cost from Europe, let's assume, so think about it. A lot of the fuel in Kenya comes from the port of Rotterdam, or perhaps from the Middle East here. Think about the freight cost. Think about the insurance cost. You layer all of this taxation, everything that comes in. Before it hits the port of Mombasa, you've got a huge amount of cost, principally, that hits on it. So if you have a refinery right there at your doorstep, all of those costs go to zero. He's able to produce, he can show you a business case where, if your costs are $1.60 per liter today, I can probably deliver to you, fuel at the pump for maybe, I'm hypothesizing here, maybe $1.20, maybe $1.10. So that sort of business case is something that should turn any head. Then to your point around inflation and some of the pressures that we're seeing there in that economy, I can imagine that some of those can be alleviated. It's a super clever strategy. I think if you ask me, one of the biggest vulnerabilities of the plan would be, where would the crude oil come from? If you ask me, that's the biggest vulnerability. East Africa traditionally is the region with the lowest crude oil endowment in the whole of Africa. Kenya has a tiny bit, but it's not massive. South Sudan, you can argue, not massive again. And Uganda around the Kingfisher, Lake Albert, Kingfisher field around Lake Albert. And don't forget, Uganda is landlocked. Okay, yes, a bit of crude oil, but then it has to be piped. They're building a pipeline from Uganda all the way through Kenya, running across Kenya to the port, around to the port of Mombasa, which is great for Dangote. Okay, but don't forget, the people building this, yes, I think it's Total and the Chinese, I think so, but they're doing that because they want to evacuate the international market. So the real problem there is that of crude oil supply. If he can lock that in, even if he doesn't lock it in, if he can without a doubt, secure some from international markets like we've seen, but produce in-house, it would be a huge game changer. It is, it's hundreds of thousands of jobs that will be created. Right. It's a huge amount of, pressure that you take off their foreign reserve, the exchange rate. It's several things all in one. Like we have seen in Nigeria. And don't forget, Nigerian one, it's not perfect as yet, but we have certainly seen, what this one infrastructural investment has done to the country. Okay. Larry, can I just add? I know we're running out of time. If you look at the report actually that the IFC put out, it's a fantastic report because it says, I think in that report, that Africa has approximately $2 trillion, and I'm going to say that it's a big thing, right? $2 trillion in domestic institutional capital. $2 trillion. So what does that mean? It's saying that Africa has $2 trillion in things like pension funds and insurance assets and public development assets, in sovereign wealth funds, all of that pulled together. So if you think about $2 trillion, compare that to $1.7 trillion, which we've had in external financing the last few years. The last 10 years, we've had 1.7 trillion in external financing, but now we're identifying in Africa $2 trillion in Africa. So it's not simply now a thing of we don't have the capital. Africa's realizing that we do have the capital domestically. It's a thing of finding a way of institutionalizing that capital and making it work into infrastructure. A lot of that capital today sits in, sort of bonds and government securities, so sort of low liquidity type investments. If we can repurpose, and I think that's what AFC is saying, if we can repurpose a lot of that capital and turn it into infrastructure capital, then even the fundraising to build those refineries can come from Africa. You don't have to go to international banks to borrow that capital at very exorbitant rates that almost make the project economics unbankable. Okay, you can find that capital now. So honestly, I think to summarize, the conference there in Kenya was super productive. I was meant to be there, I couldn't make it, but all of the points and the feedback that I got around the conference has been truly, truly outstanding.
Right. I guess Africa is sitting on a lot of money right now and funds. But before I let you go, I'm just imagining, the refinery is working in East Africa, is able to get crude oil, feedstock, and policy alignment is good there. Is it possible the fuel could get cheaper than Nigeria?
Good question. So it's difficult to answer that, but good question. So is it possible for it to get cheaper? I would say unlikely. I'm talking simply from an analysis standpoint, right? As an analyst, very unlikely that it would get cheaper. So a couple of things. When you look at the fuel stack, if you look at the fuel stack, so when I say the fuel stack, if you take 1 barrel of crude oil today, and you say, okay, 1 liter, for instance, you say, okay, a liter of oil, a liter of PMS, for instance, what's the total amount of that is the feedstock cost? Feedstock cost, i.e., buying crude oil to put in a refinery, is usually about between 65 to 70%. Okay, 65, 70%. Now, Ladi, you know that feedstock price, 60, 70%, that's traded on international markets. Nobody's going to sell to you. Today we just spoke about, we said $106 per barrel. Nobody's going to sell it to you at $100 per barrel because you're Nigerian. It doesn't work like that. It's business. So they will sell it to you, even if it's in Naira, the equivalent of 106. Okay, so feedstock cost is a given. Where you might find the advantages are in things like labor costs that you have for people working on and all of that sort of taxes, perhaps, how clever the tax system, policy alignment, is, and all of that. Things like, the remainder of the things that make up the cost stack, this is where you could find some of that efficiency. So let's say the 30%, but I doubt it, because bear in mind, Nigerian market's a very old market. There's huge amount of infrastructure that is in that market already. We have tank farms that have been built, are being run independently. We have pipelines that are being run. We have logistic networks. In those areas, the logistic networks and infrastructure is a lot more primary and rudimental. A lot of it doesn't exist. So you need to build that from scratch. Building that from scratch means that your total cost goes up, because those people building it would have to make money initially. So I don't think that could be cheaper than Nigeria. I would be very surprised. Actually, I do not think that's possible. Certainly in the first half of operation.
Okay. Well, we'll keep tracking it. We'll keep tracking pricing, and we'll see if it actually materializes right there in East Africa. Thank you so much, Chinnan Dikwal, Vice Chair, Africa Energy Council. Thank you for coming on today. Enjoy the weekend.
Pleasure. Thank you.